The other thing, though, that has really been big news this week, I think almost overly so, is the 50-year mortgage proposal that came out from our federal government here this week. And of course, you see on the slide there, I call it, is it potential? Does it have potential, or is it hype? So let me give you a little bit, at least my take on that whole debate, because I've seen arguments about this proposal on both sides. First of all, let me give you, it's a little bit of irony that I'm going to provide you through some historical context. You may remember after the Great Recession, back in those days, we had a legislation called Dodd-Frank. Now to Dodd-Frank came the creation of the Consumer Financial Protection Bureau. And with that, there was a brand new landscape in terms of mortgage guidelines, the methodology by which mortgage borrowers would be qualified to borrow funds to purchase a home, and the whole new concept called ATR, ability to repay, came to be, where we had to extensively document a borrower's income, determine that they actually could qualify for the loan amount and payments that were resulting from that loan amount based on calculating their debt ratio and their qualifying income. Now, as part of that new regulatory landscape, there was a new set of loan categories. Of course, conforming loans, which has always been sort of the predominant category to get the best type of financing, best rates. But there was a new category that rose out of all this called non-QM, non-qualified mortgage. And within that bucket, one of the things that occurred is we had to now start providing a borrower with a disclosure called anti-steering, where what it was intended to show is that we were giving a borrower a full picture, a full range of loan options for them with a rate range, lowest rates available to highest rate available based on no cost or with cost. And in terms of that disclosure, one of the things that reflected is what was the best kind of rate you could get for a loan with non-risky or no risky features. Well, guess what one of those risky features is? 40-year amortization. 40-year loans have been around for a while, but yet out of the Consumer Financial Protection Bureau came the non-QM mortgage product, and in that bucket is 40-year loans. 40-year loans are deemed too risky to be sold to Fannie Mae and Freddie Mac. So right now, today, even given this new proposal for a 50-year mortgage, Fannie and Freddie do not buy 40-year mortgages because they're deemed too risky. So why in the world would the federal government now propose a 50-year mortgage? That's the irony of it, because word is that this proposal came from Bill Pulte, the current head of the FHFA, that's the Federal Housing Finance Agency, who oversees Fannie Mae and Freddie Mac. So why would it that the head of the FHFA, who currently considers a 40-year mortgage term to be risky and therefore not eligible for purchase by Fannie Mae and Freddie Mac, why would this person now propose a 50-year mortgage? So the point there is, even if this idea gains some momentum and becomes something that is going to be seriously considered by the federal regulators, there would have to be a change in the current rules to allow the 50-year mortgage term to be eligible for conforming loans. That's what would need to be done in order to really put some teeth into this proposal in terms of providing more affordability in terms of mortgage terms. But here's the thing, some things that you need to realize, even if this idea gains some traction. Number one is, if you're going to have a 50-year term, the time value of money says the rate's going to have to be higher than a 30-year term. That's just fundamental econ, right? In fact, it's already the case. If you want a 40-year loan, which I can provide you, any lender can provide you who does non-QM loans, those are going to have a higher rate than a conforming Fannie Mae and Freddie Mac loan. And a higher rate, of course, mutes or somewhat offsets the benefit of that longer repayment term because of the higher rate. So then if you, by extension, take it out even another 10 years to 50 years, the rate is going to have to be higher still. Like right now, the difference in rate between a 30-year loan and a 40-year loan is probably in the range of about 1/4 to 3/8%. Well, if you're going to then extend the loan term out another 10 years to 50 years, that's 600 months. Guess what? The rate's going to be higher still, probably another 3/8 to 0.5%. So then when you consider a conforming 30-year fix, as you saw in our rate grid, we can offer you 5.99. Well, a 50-year loan probably is going to be at 6 3/4, probably at a minimum. And as a consequence, yeah, sure, that longer repayment term lowers the payment, but then that higher rate raises the payment. So the net benefit to the borrower isn't going to be that significant. On some loan amounts, it could end up being nothing more than maybe $80 a month. That can help, certainly. It's better than nothing, right? But at the same time, is that going to make a huge difference in terms of affordability for most borrowers? Probably not. And to the extent that this loan program, this loan term idea gains traction, and if it does attract more borrowers, it could actually exacerbate the other part of the spectrum, which is home prices. If this proposal creates enough interest that we have more borrowers stepping up to try to buy a home with this particular alternative, that's higher demand for housing. We already have a short supply of housing. That could put price pressure on the existing housing stock, which could then further undermine the benefit of this longer term in terms of mortgage payment, because if you've got a higher price, that means a higher loan amount. And again, that's going to mute some of the benefit of this longer term. And then the last thing I'll mention in terms of the risk quotient with this idea, remember, a 50-year loan, of course, means a much greater percentage of your initial payments are interest, almost all interest. So the amount of principal reduction you're going to achieve with this 50-year loan is going to be very, very small in the first several years. So what that means is you're building equity at a much slower pace, which means you're building wealth at a much slower pace. And then what if we have another 2008 scenario? Well, if you're on one of these mortgages, and even if you've had it for 5, 6, 8 years or so, maybe 10 years, the amount of equity buildup or creation that has occurred in that relatively short period of time out of that total 50 years is not going to be that significant, and lays you to be open to and at risk of going underwater in value if we have any kind of significant market downturns in terms of home prices. So when you consider all of that, is it a tool? Will it have some benefit? Yeah, somewhat. I would argue pretty limited. And in a lot of ways, I don't think is really going to achieve the results that some proponents are suggesting. And of course, there's the other big argument. Well, you're going to pay a lot more interest over a 15-year term than a 30-year term. Yes, that's true. The numbers do say that. They show that. But here's the reality. Most of us don't pay out a mortgage to term. That's already true on a 30-year loan. That's certainly going to be true on a 50-year loan. So in terms of evaluating if this product is good or bad, don't get too much caught up in how much interest are you going to pay over 50 years, because some people do that as how much interest are they paying over 30 years. I don't think that's the best analysis, because most of us, majority of us, are never going to pay out their mortgage to term anyway. They're going to sell the house before the term is ending, or they're going to most likely refi if rates fall. So that's probably lower on the totem pole in terms of evaluating this proposal. So that's my take on it. It's good, I guess what we'll call clickbait. It's definitely generating a lot of interest, a lot of debate in the markets and in the media in general. But to what extent will this become a major part of mortgage offerings in the U.S. mortgage industry? I am not convinced it's going to be a big factor. So we'll see how it plays out.